I always say that the perfect trade is when hypothesis, price, and narrative lines up.
And you are saying that from your NLP models, the invasion was looking likely.
A geopolitical event or a new policymaker becomes a turning point in an economy.
Do you think there's something natural in the length of these cycles?
You have to make politics part of your investment hypothesis, trying to quantify that which is very difficult to quantify.
If you like the times when politics get messy, you have fun times all the time.
When politics mess up the beauty of macro theory, that's when I put my thinking cap on.
I don't see how it's necessarily going to get easier for you to anticipate these turning points in the way that you'd like to.
How can Kamala and Trump get their voters to show up at the polls and vote?
Hello and welcome to Capital Horizons, the podcast where money meets politics. I'm Igor Yelnik. My co-host is Sir Michael Fallon. Our guest today is Pascal Kummert, founder and CIO of Calvion Capital. Hello, Pascal. Very good to have you on the show.
Thanks for having me.
So we live in a very interesting environment, and things are happening all the time, everywhere. You are managing a macro fund, a global macro fund, and these events affect your daily business, as far as I understand it. How do you navigate through this uncertain geopolitical environment?
Well, it's not just that they affect the business. In a way, I've made it my business, and it's more than just a risk, but also to some degree a set of opportunities, which I feel in previous cycles weren't as relevant to market participants, but certainly have become now in what we have internally coined as the age of geopolitical disruption. But yes, I mean, what we're effectively seeing is that these non-market actor events are having a much larger impact on markets, whether they are extending a trend in a macro environment, just like the Russia-Ukraine situation was an accelerant of what was effectively a inflationary cycle or regime, or can be a turning point, and where either a geopolitical event or a new policymaker becomes a turning point in an economy. I think what we're seeing in Argentina right now is just another prime example of that. So how do you navigate those? There's a long answer to that. The short answer is that you have to make politics part of your investment hypothesis or geopolitics, and really understanding those events, which effectively trying to quantify that which is very difficult to quantify. And you can do that through various scenario analysis. You can use natural language processing to inform your subjective probabilities. But I think it's always a combination of a fundamental approach with a quantitative approach that allows you to navigate these difficult biases that we have on the human side in these processes, but also have that awareness when, say, a purely systematic process gets too far over the skis, and there are very dangerous end of trend reversals that when you have a political analysis around it, you can see that the skew is potentially against you. And I can give various examples of that, the ruble before the Russia-Ukraine invasion, what we saw with dollar yen just at the beginning of August. It's always that combination of the market forces and then also the non-market actors that often tend to lead to either turning points or really strong Sharpe ratio accelerations in trends.
All right. It's interesting you mentioned the ruble before the invasion in 2022, but the ruble itself didn't appreciate that sharply. I think it was just difficult to trade it. Spreads widened.
No, the way I was looking at it was, we have a cross-asset macro approach. So we look at various different asset classes, especially around political events, and then from either option pricing, try to discern what probabilities are implied of certain outcomes in the tails. It can be the tails, or it can be the modal outcome scenarios. But in this case, what we observed was an interesting difference between the degree to which Russian equities had sold off in January and February of 22. That was ahead of the invasion. So the invasion was, I believe it was on February 24th, right? And
because the 23rd is the day of the Russian army.
Yeah, so I think it was the night of the
it was a public holiday, and then they went the following day.
In the US, it was the night of the 23rd going into the 24th, I believe. Yes, so the interesting thing that we had observed on our side was that the Russian equity market had been punished quite intensely already. But the ruble itself was still pretty stable. And the way we were looking at it from what we assumed would be the move on various degrees of an intensity of an invasion, or this whole hypothesis of that Putin was just saber rattling and trying to extract a certain demilitarization. You map out all those scenarios and your expected values, then you can look at the option market in the ruble. Because here was the interesting thing. If you were a traditional macro risk taker, or even a systematic FX trader, the trend in the ruble and the carry of the ruble and various factors were very positive. If you looked at the fundamentals and the things that usually drive the ruble, whether it's current account expansion, oil prices, the fiscal measures, the ruble was the best trade to be long. Now, if you looked at the implied probabilities in the options market for an outsized move, it was somewhere around 10% on the tails. So kind of like a 2014 Crimea invasion type event. And in the equity market, it was priced at around, from our own assessment, somewhere between like 40 to 50%. So we went through our own scenario analysis, and we didn't believe necessarily that the modal outcome was an invasion, but we believed that that tail was massively underpriced. So on the ruble side. So, you have these different asset classes, and you can see this is interesting. There's a clear differentiation of the probabilities that are here. And then you dig into it and you're like, why is that? Well, it's because the fundamental risk takers and the systematic ones tend to be on one side of the boat right now. And they're not doing this political scenario analysis where they're really getting into that. In the equity market, it was a different story. So it's not an arbitrage of probabilities, but it gives you an awareness to some degree, and you could buy those tails very cheaply. It really then kicked off when the sanctions hit it, right? Because I think the first few days, the ruble didn't do too much, and then the sanctions kicked in, and that's when it really accelerated. But effectively, our view was that the probability of an invasion was probably 20 to 30%, and we had used another part of our process, which I think we'll probably still touch on a little bit more further down. But the one piece in the puzzle for Russia that was missing for us was that while there was a lot of hype in the international news around the invasion, and it was to a large degree driven by US intelligence that was putting that narrative out, the Europeans were, I would say, fairly dismissive of that and wouldn't really believe it. I mean, the Munich Security Conference was just a few weeks before that, and nobody really expected that this was anything like that was going to happen. They still had diplomats, German diplomats in Kiev, which they had to get out. So they were pretty oblivious to the risks. So what we found, though, was that in the local Russian news, in January and early February, there was absolutely no mention of what was going on at the border and the troop buildup there. Pretty much none of it.
That's right.
Now, we believed that if an invasion was going to happen this time around, it would be different to Crimea in 2014. It wouldn't be completely under the cover because there had been so much buildup, and it would be such a much larger event that would have to get the population on the side. So we would have to see some form of mentioning, or at least propaganda being pushed out. Now, what we did is that we trained a natural language processing model on Russian news based on a data set from 2014 around Crimea after the invasion to effectively pick up combinations relating to war and conflict in Russian news that are, you can say, typical combinations of words and phrases that would be related to the way that the Kremlin pushes out systematic propaganda. And we trained
and you are saying that from your NLP models, the invasion was looking likely.
it definitely shifted a few weeks before. And if you remember back, there was this narrative of denazifying Ukraine. That was the narrative that came out. Now, if you are a single human decision maker and you're processing Bloomberg headlines or news in a linear format, you're like, okay, that's worrying. This is something new that's coming up, and maybe that shifts my probabilities. But if you have a net that is effectively taking in all of the Russian news and can show you and quantify how systematically these narratives are trending and really are being systematically pushed out in all of the news. So now you're thinking in a multi-dimensional space. That definitely gets your alarm bells ringing. And that's what happened for us. And that's why we then leaned more into those ruble shorts and believed through options and believed that probability of the tail was definitely more than 10%, 20 or 30. But if that works out, that's a good trade. So that's one way how we utilize, I would say, human, but also quantitative approach to address these, what I would say are, high complex problems and often have their own specific nuances and different tools that you need to then calibrate to solve a very unique problem at hand for which you don't necessarily have a great precedent.
Okay. If we speak about problems at hand, you mentioned one of them, Japan in the beginning of August this year.
So Japan has definitely been a very interesting trade, and I think we've followed it and had various expressions in various asset classes. Again, I think up until, was it mid-22? Yes, mid-22, the dollar-yen trade was certainly the best Sharpe ratio trade in that complex. But you always have to, I think, a large driver of the yen is also what's happening in the bond market, and the interest rate differentials still have a big effect there. But with the policy that has been put in, the liberalization, the understanding that inflation is a thing again in a society that has completely forgotten about inflation, and wages are rising, and it's in a strong economic point now where it's benefiting from the weakness in China to some degree because it is diversified, just like India has been, and capital is flowing into there. And we're really seeing, very old and dusted sectors of the economy becoming more shareholder friendly. So this is certainly a longer economic cycle that is building there. But within that, there are different ebbs and flows. And, what we found, I think, is that with these big macro ideas, and this is always the risk with discretionary macro risk taking, is that there's a lot of hypothesis crowding, and people get very comfortable with their views, and especially if they get positive reinforcement through trends and prices working. And just like many trend following CTAs, they do then tend to add to their winners and become bigger and bigger and bigger, and often have somewhat of complacency around turning points. And that's where, we always think of a trade as having 4 life cycles, one being the early inflection phase, one being the early trend phase. Then you've got the meat of the trend, where your Sharpe ratios are highest, where the CTAs are coming along with you, and you're getting continued justification for being in that trade. And then you get to the tricky phase, which is the end of trend phase. And that's the one where I feel macro risk takers get hurt the most. And I think that's exactly what we saw in dollar yen, because if you look at dollar yen, the turning point wasn't around the BOJ decision.
No, it was around the 12th of July.
Exactly. It was in mid-July. So you basically had a month where you were giving back the gains that you had made in the previous month. And then beginning of August, we had the big dislocation, and everyone's suddenly talking about the yen carry trade. And
So what do you think happened in mid-July that people started to buy the yen again?
I think to some degree it was really it was exhaustion of the existing narrative. We also had the bond market turning somewhat in the US, so that led into that as well. There's the whole narrative around the slowdown, so there's interest rate differentials. So I don't really necessarily say, you can point to some of the political developments there as well, but I don't really think it was that political driven in this case. It was really a market exhaustion phenomenon, and that's always the tricky thing.
So you don't think that the markets anticipated what was going to happen in the end of July with the BOJ decision?
I think some people did, and I know of one or two large funds that made good money of that turnaround. For me, I wasn't that focused on dollar yen at the time, because for me the Japan trade had already previously shifted into equities. That was still the better trade, and that also had a pretty phenomenal drawdown. But that was at least where we were in the cycle of the economy plus the policy framework, where it was more of a Nikkei or topics expression trade. Yeah.
I'm interested, Pascal, you used the phrase exhaustion. Having described the four phases to your cycle, do you think there's something natural in the length of these cycles? What is it that's going to make it easier for you in future to spot similar turning points?
Yeah, so again, for us, our process is always a triangulation between three things. And one is, I always say that the perfect trade is when hypothesis, price, and narrative lines up, right? So you want to have the right idea, and the order of these can always be different. Sometimes, when I say price, I mean price behavior, time series analysis, signals that we're getting out of price data to a large extent. To some extent positioning, but that's something we've struggled more with on a systematic basis, but definitely have looked at a lot in terms of awareness. Now, you want to have the right idea, the right view, the right hypothesis on your macro view, on your expression of your various scenarios and the subjective probabilities that you've assigned to them and the expected values. That's one. Then you want to have prices behaving in such a way that they are confirming that view, so you can build confidence on that, and price is how you get paid. So it doesn't, having the best macro hypothesis and markets just not caring about your theme at all is often a recipe for disaster. And then the other one is narrative, because sometimes you do have price and hypothesis coming together, but you don't know if that's randomness in the price or if the price is moving for something completely different that you're not aware of. But you want to see that narrative lines up as well. Sorry, remind me of your question.
Well, that question really was, do you think there's something natural when you talked about market exhaustion on the dollar yen position? Do you think there's something natural in the cycle of these things, that the rest of the market catches up, attention moves on?
Absolutely.
Or is this...
Absolutely. I think it's very much that's why we put so much emphasis on narrative as well. It's hard to quantify and trade purely on narrative through natural language processing. It is a bit of an 80-20 approach, but it does give you a strong sense of it. Let me give you a better example of something very recent where we had that. Chinese equities. Perfect example. Huge pain trade for the systematic community as well, and to some degree the discretionary community. Again, one of those situations where I think it was momentum and even carry factors came together, and we found that everyone was on one side of the boat and there wasn't a natural seller really anymore. So effectively what happened was, and you could see this very clearly also in social media, there was so much China bashing happening in the weeks leading up to the stimulus.
Mm-hmm. Yep.
The whole, and I was even posting about this, which was correct, the whole balance sheet recession that is in China and how there is no solution, how policymakers are not taking it seriously. And it was basically crickets out of China. So we had a very strong negative sentiment building on the narrative side. You could see that in price action as well. I'm just going to talk about the 850 futures as a reference, where we're trending quite nicely, actually. It was a good sharp ratio short. And we then found that, and this is the great thing about sentiment and natural language process driven narrative quantification, is that, again, there's a life cycle of them. You find that they can, when it's trending, it gives you a sense of, yes, this is what is driving the prices, and this lines up with my hypothesis. So I should be taking more risk because this is playing out. So it's effectively a confidence building indicator. But there are also extremes and turning points, where you really get to that. Everyone believes now that China is in a very dire situation. There is absolutely no way out. We all find ourselves in one way of the boat. You almost have no natural seller. And then you have that non-market actor coming in and putting in policies which are probably not the ones that solve the problem, from the analysis at least, and from what we believe, but we're certainly not to drive an exceptional pain trade in equities. And the positioning was all on one side of the boat again.
But didn't your models see that stimulus coming?
I mean, one expected it, that it would have to come at some point, but there really was no indication of timing. So, we know of a few investors who had been quite vocal about being in the China trade. I think Appaloosa was one of them. And that was a very painful trade to hold for the last 6 to 12 months. And, we were always joking about when is that one day when you pick the bottom in Chinese equities. And so what I'm saying effectively, and to your question, is those turning points are, you can see it to some degree in the price data. And I think, and it's more so when prices go parabolic. So that's the opposite what we have in Chinese equities now, that there is a risk of the turning point, but it's very difficult to then time those. And then the second part is the narrative exhaustion. And that you tend to be able to see a bit more when that starts to happen. And when you get that turnaround. I still remember back in the Trump administration, when we used to trade the ruble based on natural language processing, turning points around the sanctions, which was kind of like an evergreen topic that resurfaced every 6 to 12 months about these are going to be the sanctions. And then it's like, yes, but it is the best FX trade out there. And we just have to wait until the hype dies down and then we can get long again. And that's kind of that helped a lot with the turning points. So the interesting thing was with Chinese equities is, the first day of the announcement, it seemed meaningful from a market perspective, but not necessarily from being the solution to the problem. So I think, a lot of people who were still in that trade were quite dismissive of it and weren't willing to flip around and either, get long. And that's when, after 2 or 3 days of constant new stimulus announcement, you just had that extreme buildup. I think it was iron ore even went limit up for a day or two. And people found themselves on the wrong side of the commodity trade, on the wrong side of the equity trade, not so much in the FX side. But what we tend to do if we find ourselves in a stage 4 situation, end of trend, is we move out of linear delta 1 exposure back into options.
If we go back to Japan, the beginning of August, and compare it with China and stimulus there, there were some interesting market moves over there, right?
Absolutely, yes. It definitely overshot. If we look at the A50 futures, we have a before announcement to peak post was about 40% of a move, right? Now it's given back almost half of that. But yes, there was very strong systematic short covering going on from large players. And I don't need to name any names. There are articles out there of some that got caught in that. But yes, and it was because I think momentum and, in this case, carry. So, funds that are shorting equities to then collect the carry. And I always find that one a bit dangerous in kind of low interest countries to try to milk a carry factor out of an equity trade on one side of the boat again, all on one side of the boat again, and then having to go through a positive volt shock, right? So here we have a right tail event, which is very rare to have multi-standard deviation right tail events. It's usually multi-standard deviation left tail events. The only other strong multi-standard deviation right tail event that I remember right now in terms of equities would go back to the vaccine announcement, right? So that's November of 2020.
Well, if you remember March 2020, when the stimulus was announced, it was quite a significant right tail event as well.
Yes. However, the volatility was also extremely high. So if you look at it from a Sharpe ratio perspective or standard deviation perspective, I think it was lesser to a lesser degree, whereby when the volatility comes down and then you have a bigger move, then that's like from a risk adjusted perspective. Yeah.
Well, maybe you have your own way of looking at it. I just remember those days seated at a ski resort in France, absolutely deserted, by the way. I just watched the markets going 10% down and then 10% up.
Exactly. That's the thing. You had the whipsawing, right? And that's a difficult environment to adjust to if you're managing to sort of near-term volatility as well, because you'll catch the move maybe, but you'll have a very small position if you're volatility weighting it, right? Which
yes,
less of the case. You know, if you look at the volatility in the A50 futures, it was a pretty, in the month leading up into it, it was a very smooth and a sell-off with very few challenges to it, right? And that's one of the things that I always look into is how is the price time series behaving? Is it being challenged? Is it are we seeing positioning that is against the move? Is it decreasing, i.e. short covering, or are we seeing the systematic community coming back with it and riding that trend? And that's good. There's never one right answer, but you have to look at it in the situational context. That's where I always find having that. I believe that for me, systematic signals are very important. They can give me confidence around turning points, that there is some form of exhaustion and that maybe the market is in balance now. And if we do have a new catalyst, then we are more likely to have a price reaction in that direction, that favored direction on the turning point. Or it's giving me conviction that a trend is building and you can potentially ride this and have more risk on with a tighter drawdown or take profit limit, because you're less likely to get challenged because the probability skew of the distribution is more in your favor now. So that's good. So, and I really struggled with this as a human decision maker because my background was actually more distressed investing and value based. So when I got into macro, the biggest challenge for me was adding to a position that was working, because I thought the risk reward is no longer that good. But if then you have to have systematic signals that kind of override you and tell you, well, if it is working, the probability skew has shifted in your favor, so the risk reward might still be as good, even though if you're thinking of it from a levels perspective, it might not be. So that's why I think systematic signals are very important. But then I also feel that the human awareness around risks that are building, whether it's crowding or a complete narrative shift and an understanding of what I always call the non-market actors, which are effectively policymakers, geopolitics, and also socioeconomics. And I think the whole story of income inequality and what that means for political polarization within developed markets, which I think since Brexit hadn't really been on the radar. That is something that we now live in for this market decade, I believe, and it's part of the day-to-day business.
It seems to me that as these multi and non-state actions and actors multiply and fragment, I don't see how it's necessarily going to get easier for you to anticipate these turning points in the way that you'd like to. Can you keep improving your modeling?
I mean, for me, it's usually the more these events happen, it's not always easy, certainly. And under the Trump administration, it will become a lot more interesting again with the level of noise in social media and the uncertainty around that, and him shooting policy recommendations from the hip that then may or may not get implemented. But it definitely makes it interesting and a better opportunity set for me, because that's really my sweet spot, is that combination of when politics mess up the beauty of macro theory and pure econometrics. It's basically when politics get messy and create these dislocations. That's when I put my thinking cap on, whether it's before those events or understanding when these events have happened and how likely that is going to lead to various knock-on effects in macro markets. That's the really exciting time for me. If I think of the last 18 to maybe 24 months, in terms of political or macro political narratives that have really led to, say, multi-month trends in macro assets, there hasn't been that much. So it's been a little more uneventful. So I think going forward...
I'm sorry.
I was about to say, Pascal, that if you like the times when politics get messy, then you have fun times all the time.
Exactly. So that's probably the new regime we're going into again. When the equity market is rallying straight and tech stocks are doing well, I'm usually sitting on my hands and don't have much.
Yeah. Okay. Now, speaking about geopolitical instability, can we talk a little bit about the Middle East?
Yeah. So the Middle East, I think, is interestingly enough, right? Since I think we're almost, is it a year now? It was early October, right? A year now. Yeah. So very interesting situation there. One of the few events took everyone by surprise. What Hamas did, there was, clearly in the intelligence community, even on the Israeli side, and the best, if not one of the best, if not the best intelligence network in the world. Very little forewarning of this, so there was nothing really you could pick up in advance, and there was certainly nothing on the natural language processing that you could have picked up in, say, local news. It was incredibly well kept under guard, which then surprises you when you see how well Mossad has been embedded in Lebanon with what happened over the last few weeks. So there wasn't anything to pick up before that, and then even after that, the macro themes were very short-lived and very few. In fact, there was no real knock-on effect aside from maybe trading, oil and the shekel for a few days around the sentiment. But there was no strong macro trend that led to. There was no acceleration in a global inflation regime as we saw coming out of Russia and Ukraine. There was no kind of food shortage theme that developed like we had in Russia and Ukraine. So very different there. So
but Russia-Ukraine had a major ripple effect on the European economies, quite an obvious one. With Israel versus Hamas, the biggest question at that time was about a potential war between Israel and Iran. And it seemed like the market...
Now too, exactly. And I think it really comes down to the U.S. and the relationship with the Israeli administration, which is very tested right now. I think they're very concerned about Netanyahu being a bit of a loose cannon, but to the extent where a full strike on substantial military facilities and or nuclear facilities in Iran would be instigated by Israel, I see the probability of that being very low still. So to that degree, there is, but from the U.S. administration, there's a lot of concern right now. The main thing is that they're trying to keep it as quiet as possible around the election, because it is one of the themes that is hurting Kamala and her base. If we think, and I think the bigger picture right now, less so in terms of oil markets, and how things and the tail, a left tail event triggered by Israel, I'm less concerned about that in the near term. I think the bigger theme for markets is now obviously the US election. And I think in the US election right now, from what we're seeing, it's still very close. And it's all going to come down to turnout. No one's going to change their opinion anymore now. And it really comes down to how excited can Kamala and Trump get their voters to show up at the polls and vote. And Kamala's lost momentum in the last few weeks. And stories with the fractions within the Democratic Party around AOC and Lena Khan, that hurts exactly that base and those voters that Kamala needs to get out. And that's going to be key here. So I think...
So what's going to happen after the elections?
With Israel? Or
yes.
I don't have a very strong view on that, I must admit. I think I think we do avoid the full Iran conflict. That is something where there are too many forces in play for that. And to be honest, I don't think the Iranians have that fight in them. So it really comes down to keeping the hawks in Israel at bay. But we did see. I think it just came out yesterday that we had U.S. bombers bombing facilities in Yemen where there were underground weapon storages. So but it's kept very, very quiet, and it's not in the larger sense in the media. And I think that's because of the election. But I don't really see a willingness or ability. And this is what does it come down to? We did the same analysis before the Russia-Ukraine invasion. Even though we then saw that the probabilities were shifting somewhat, on all of the military analysis that one did, it was very difficult for Russia to pull it off. And a few things could have gone differently, and maybe they would have made it into Kiev in that first storm. But we all take it back to Putin being misinformed by his generals. And when you do those type of military analysis of how much is needed, where they would need to be, you play that out, the war game of it. It was very difficult for Russia to do it. And I think a scenario in which there is a new stable equilibrium between Iran and Israel, where a military outcome can induce that, it is very difficult to see that. So if anything, the current equilibrium is more stable than one that we could see being reached if Israel were to retaliate in a further escalatory way.
Yeah, I think that's right. And the Republicans certainly who've been through London recently, the senior ones, Pompeo and Colby and Pottinger, all auditioning for jobs in a Trump administration, of course.
Yeah.
But when you ask them about Russia, or you ask them what Trump will do about Iran, they turn immediately back to China. That is far more important for them as to how tougher Trump is likely to be on China than he was in the past. They talk about China's role as an intermediary with Iran, and they talk about stopping some of the Chinese and North Korean supplies that are going into Ukraine. But it is all focused on the Pacific.
Yeah, China is kind of the easy adversary here, but I do worry a lot about China. I think post-COVID, already pre-COVID, China has entered in I think Xi Jinping's third phase now, where there is geopolitical expansion. There are constant tests of trying to break out of the multiple rings of barrier islands and cement themselves there. And then I think obviously the one for investors that was the systematic crackdown on the private sector, right? Which I think was to a large extent a shot in the foot, because it sucked out the oxygen from any entrepreneurialism. I saw a chart recently just about new company formation and obviously foreign capital flowing into China, and it's pretty much dried up. And but the big thing is that with China is that it's isolated on all fronts now. I mean that in the lockdowns were on much longer than in any other country. What that does for the population psychologically is one thing. Then you're diplomatically isolated from the broader sense of the Western world, more so than ever. And then economically isolated as well. And I think that's a very dangerous combination, and it leads to irrational decision making. And I think, Putin got to a point where I don't think he really wanted to do it. And then he got to that point where something flipped, and then they're like, now we're pushing out the propaganda and we're doing it. And that's what I worry with China, that it becomes more of a loose cannon. Now, we're not there yet. I think, we've talked about war games and simulations, and many have been done with Taiwan and looking at the forces that are present there, and with the allies. Up until 2027, it's still pretty much a toss-up of who would win, and the degree of fatalities around a invasion of Taiwan. So, but China is building, and building rapidly. And I think just the way that warfare is going to change over the next few years is, I think Russia-Ukraine gave us a taste of that, but we will see a lot more spending and a lot more getting focused to unmanned aircraft, drone warfare, huge game changer, right? So that's going to benefit the aerospace industry a lot. There's so much that is going to happen and be completely, I think militaries are going to be completely reorganized based on that. That's really,
exactly. And a lot of it may constitute a long phase before any actual invasion. It may be blockade, it may be grey warfare, it may be underwater, it may be all over the place.
Yes. So something
and quite intense. And I think that is what is really worrying the Americans at the moment.
Yes.
If you look at the relative size of the navies and the relative expenditure on some of the autonomous weapons.
Yeah. But America is getting the advantage in innovation again, right? I think if we think back before the Trump administration, and at least in the technology sector, and if you ever got to experience WeChat, for instance, and what they were doing in the field of AI before the Trump administration, China was ahead. China was definitely ahead, and I think now at least it seems that the U.S. has the advantage in AI and generative AI, and that's where all the capital and innovation is going.
Unless you start thinking about where all these chips are produced.
Yes, that's obviously another. Mexico soon, right? So we'll see.
Yeah, we'll have to wait a little bit.
That takes a bit, yeah. But we're seeing this everywhere. Even I had a conversation with a former colleague of mine. There's the Data Sovereignty Act in India. Means that they need to produce the chips locally now, that the data centers for generative AI need to be local as well. So there's a whole trade around Indian utilities that is very interesting as well, which obviously we've seen with nuclear in the Western world now as well. So I think that's been like a whole interesting geopolitical proliferation trade. But then, of course, the other big post-Russia-Ukraine shift, and probably the biggest one, I believe, and this is a very, very long one. You always get the dollar hegemony being brought up as a macro trade, and it's makes sense in theory, but you can't actually. It's very difficult to trade it based on that hypothesis. But gold is the clear winner from this, right? Gold has, in its correlations, decorrelated from real rates and other macro indicators that you would usually look at. And why is that? Because, say, to a large degree, central banks, or the central banks of countries and their reserves, those countries that are maybe a little suspect or less friendly now to the Western world, are seeing it as the only other alternative to the dollar. the euro doesn't really help them much more. They'll still be, and it all comes from what the asset freezing after the Russian asset freezing after the sanctions came in place, right? So that's a huge change there. That I think those are the biggest pools of capital in the world, central bank reserves, and that's been a very meaningful shift that has nothing to do with economics. Again, it's purely geopolitical driven.
Yes, and I don't think that this process can be stopped now. The effect of Russian asset freezes, those colossal sanctions imposed on Russia, will probably change the mind of emerging market players very significantly. We tend to think about them as emerging markets, but actually, if we look at GDP at purchasing power parity, then China is bigger than the US. And in top 15 countries, I think 8 are so-called emerging economies, like China, India, Russia, Brazil, and so on. And Canada, I think, is number 15. The West has to be quite careful about what it does and how it imposes sanctions and whether it actually weaponizes the existing incumbent financial system.
Yeah, very much. I mean, not a month goes by where some form of alternative to SWIFT or the crypto world has been obviously jumping on that bandwagon, but to the extent that anything has really been done there, I don't think that's quite the case where there's been a real alternative found. So then gold has really been gold is the new TINA asset. There is no alternative, at least in terms of the dollar. Yeah, what equity used to be, right?
Yeah, indeed. All right. Pascal, I think it was very interesting. Thank you very much.
Yeah, very much a pleasure. And I think the last time we met was at a capital raising conference in early 2019. So I hope we get to not wait that long until we connect again or maybe even meet in person when I'm in London.
Thanks for listening. This has been Capital Horizons.
So if you'd like to see or learn more about Capital Horizons, please subscribe below.
From Michael and I, see you next time.